Did you know there's an account out there that you could participate in market gains, never be exposed to market losses? You'll be able to leverage and access your account throughout the growth of it without interrupting that account value and affecting the rate of return. You would think that these accounts would be exclusive to the ultra wealthy, which they were in the past, and they were used by Ray Kroc, the creator of McDonald's, Walter Elias, the Disney creator, right? And like the Rockefellers, for example, who've created some of the largest generational wealth in the history, tax-free. Well, these accounts aren't exclusive to them, and you could actually have one too. Let me introduce myself. My name is Austin Becker. I'm the co-founder of Becker Life and Investment Group alongside my wife, Jessica Becker. And today I want to talk about these accounts. These accounts would probably surprise you. They are life insurance contracts, right? So more specifically for today, they're going to be permanent life insurance contracts. And today we're going to talk about an indexed universal life insurance policy, an IUL. You've probably heard about it. You've probably been on the fence. You've probably been wondering, how do they work and how can it work for you? So today I'm going to break it down in the simplest form possible using this illustration. So stick with me. I'm going to break it down so you have a clear understanding of how an IUL works compared to some traditional retirement accounts that you may have heard of, like a 401k or an IRA and mutual funds, right? And kind of how you can use this in and day out life. So take a look here. We have John. John is somebody like you and me. They go to work and he makes money. What happens with John's money? One of three things typically will happen when John makes money. He will pay bills with his money. Bills, that money is gone forever. He will never see any more money, pays the bills, and then he gets no rate of return. It is what it is. He then will put some money in a bank, right? That's typically what we do. We put our money in the bank in a checking account most of the time, sometimes a savings account. And the average rate of return in a bank savings account is 0.42% APY, okay? Your money is accessible within reason. If you try to access 100 grand, they won't be able to get it and they'll tell you it'll take a few days. It's guaranteed for the most part. I don't want to get into that. Some banks have been collapsing, but for the most part, it's a comfortable place for you to put your money. I would agree with that, okay? And then the other thing is, you get a 401k. So these are the three places your earned income goes to. A 401k, a lot of times people will contribute to for retirement planning, right? So their company will take it out of the paycheck and you will never see it, right? So that means they withhold it before you ever see that money. You're pretty much being like, hey, Mr. Employer, you can take my money and I'm gonna let you take all of the risks, or I'll take all of the risks. You take the money, I will pay you a couple fees. I don't even want to see the money. I will pay taxes on that later, right? And then I hope you grow my money. That's essentially what's happening for the next 30 years. But let's take a look at what happens when you put your money in the bank first. So if you put your money in the bank and you have saved 50,000 bucks in your bank account, okay? So you have 50 grand in the bank. But John here wants to go buy a car. John's not going to want to touch his $50,000 for the car, right? Because typically we don't want to deplete our reserves. Most bank accounts are usually going to be used for emergency funds and or vacations, let's just be honest, and bills. So what John does, instead of using his own money to buy the car, John takes a loan out. This $50,000 loan, subject to a 10% APR, current rates, that's actual realistic. It used to be like 2, 3, 4, and 5. It's 2023. They're anywhere between 7 and 12, so we brought it in the median at 10%. Assuming a 10% APR, John here will have the car for 5 years. Also not realistic actually, because most people finance their cars for about 8 years these days, just because the cost of vehicles have gotten so high, but we're not going to talk about that. $50,000 loan, 10% APR, 5-year loan, so 60 months. John will have paid $63,741 for this car. And when he pays that money, he's paying it back to the bank. His account has not changed. He's got $50,000. He will have probably gained a couple $100 in interest. It would actually probably at a 0.42% gain about $1,000. But overall, the bank profited $13,740 from John's money. He borrowed money. That was his money that he put in the bank. It wasn't technically his, but he borrowed somebody's money, right? And it was equivalent to the amount he had. And the bank made $13,740. There's an alternative to this. When you have an IUL or a permanent life insurance policy, you get to be your own bank. And we're going to talk about that, right? So let's jump down here to the 401k though. So John over here, he's got his 401k. Let's talk about a 401k. 5 to 8% APY, right? Annual percentage yield, right? That's what he's going to return. You guys might want to argue and say 10%, 12% APR or APY and stuff like that in averages. We're going to talk about averages and actual rates of return because there's a huge misconception on actual and averages. In fact, let's go ahead and talk about actual and average rates of return. So take a look here. If we want to talk about average rates of return, here's an average rate of return. Say we're going to do super simple math. We're going to go up 50%, we're going to go down 40%. Up 50%, down 40%. Up 50%, down 40%. If you average that up, you would take the sum over the amount of time. That was 6 years. Take the sum of it and you divide it by 6 years. What is our average annual return? 5%. Okay? That sounds good in theory, right? Obviously, this is very, very like off the wall. We're not going to gain 50 and 40, but to break down what averages are, up 50, down 40, up 50, down 40. Let's calculate the average. You get a 5% average, right? Average rate of return. You hear people talk about, I average rate of return 10%. That's what they market to you in your 401k forms, right? They're like, you log into your Vanguard account, your Fidelity account, average rate of return, right? We're going to get into actuals, right? But let's talk about average. Average rate of return, 5%. If we were to average an actual rate of return of 5%, this is what would happen. We're going to say we start with $100. $100 would yield 105, 110, 116, 122, 128, 134, for a total rate of return of 34%. The problem is that's not actual, because when you go up 50% and down 40%, this is what happens with your money. You start at 100, you go up to 150, but then we lose 40%. What happens when we lose 40%? We come down to $90. So then we go up 50%, we're at 135. We come down 40%, we're at 81. We go up to 122, we come back down to $73. So now with an average rate of return of 5%, but an actual rate of return, we're down to $73. That's a 27% loss. If we actually pull this out to get the geometric average and we calculated 50 up, 40 down, 50 up, 40 down, 50 up, 40 down with actual geometric results based off of the amount of funds that would be in your account, you will do the math. We're not going to do the math. You will have a result of negative 5.1%. You would have lost 5% each and every year, okay? Each and every year. Because remember, your actual loss was 27%. So you had a negative 5% actual rate of return, okay? So we're not here to talk about that, but that's what that is. So let's jump back over here real quickly, and we're going to take a look at your 401k. So your money that you have left over from work goes into a 401k, 5 to 8% APY. You can't touch this money until you're 59 and a half most of the time, right? That's the restrictions, 59 and a half, unless you want to pay penalties and stuff like that, right? There is no guarantee on this money. You gave the employer the money. You said, do whatever you want with this money, and I hope you make better decisions than I would, right? There's no guarantee. There's no floor. There's no guarantee it'll be there. There's nothing, right? It's taxed in the future. You will pay taxes, right? And what are the tax rates going to be? Currently, we're going to equate for about 30%, but what were they in the 80s? And this is about 60%, right? So that tax rate is going to fluctuate, but let's just say it's 30%. There's fees on top of fees on top of fees that you're unaware of. You have admin fees, you have expense ratio fees, you have 12B1 fees, you have advisory fees, you have early access fees, right? And if you pull the money out too soon, which 37% of people, statistics, pull or touch their 401ks before 59 and a half. Most people touch them and they pay penalties, they pay interest charges, they pay to pull that money too soon. There's probably more fees I'm not even thinking about, right? So let's take a look at what happens in this 401k. So this 401k in 30 years, let's say John puts $1,000 per month into this 401k. John will have put in $12,000 per year into this 401k. His CAGR, compound annual growth rate, actual rate of return, specific to the S&P 500 over the past 20 years is 8% APY. You can Google everything. It's going to tell you average is 9 to 10. Everyone's going to tell you. But look up the CAGR, 8%, 8.01% if we want to get technical, okay? So using an 8% CAGR, his account value, John's account value was $1.468,150, right? That's how much money John had in his account. However, let's be conservative and say his fees were 1%. You may say that's too high, and some people are like, that's really good. 1% is the industry average for an in-person advisor. Robo-advisors would be about 0.25 to 0.5%, but overall, collectively, your fees are going to equate to around 1%, if not more if you're using private financial advisors like Edward Jones, Charles & Schwab. They get upwards of 4% sometimes. But let's just calculate a 1% fee. A 1% fee on 1.46 million would be $255,273, leaving John with a retirement balance of $1.212,876. So $1.2 million, okay? From here, that money is still going to be taxed. 30% taxes on $1.2 million, that's easily, what, 30, that's still another 300,000. It's 300,000 just on a million, right? It's gonna bring him down, there's $360,000 coming off of that, bringing him below $900,000. Saying he has about we'll just say he has $900,000 after taxes. What else is happening? His money is still exposed to the market. He's still subject to market risk, right? And what else? Once it's gone, it's gone. As soon as he runs out of that money is gone forever. It's not uninterrupted. An IUL, for example, is uninterrupted. We'll talk about it. But this account is gone once he uses it. So therefore, they created a 4% rule. This 4% rule is like, hey, if you take 4% of your retirement, you should be able to not outlive your money, okay? Well, taking 4% of that account at a full 1.2 million would be $4,000, right? $4,000, and then after taxes, that's $2,830 per month. $3,000 per month. So he was saving $1,000 per month to retire with $3,000 per month after taxes. But guess what? That gets worse. So let's jump over to a hypothetical real quick. A hypothetical but real, right? So if John was to retire in December of 2021, John's account was $1 million. We're using this for average numbers, right? John's account had $1 million. In 2022, he took out $50,000 to live for the whole entire year, right? Well, at which point in time, if he took out $50,000 from $1 million account, he would be left with $950,000. Well, $950,000 sounds good in theory, but the S&P 500 lost 20% last year, right? So at which point in time, since he's still subject to market volatility and market losses, he lost 20%, therefore bringing his account value down to $760,000. Okay, well, starting of 2023, John needed to take income for the year. He took $50,000 out. His account value is now $710,000. In 1 year, John lost 29% of that account, even though he only took about 5% out, right? So this is the problem with most traditional retirement accounts, is the fact that it's going to consume itself. It's going to be depleted because when you use the money, it's no longer there. And as soon as the market tanks, you lose a lot of your account and you lose your advantage place. You can no longer, your position is gone. You're no longer there still playing, right? So let's get out of here and let's go look at what John could do, okay? So John could get his money, earned income, got his bag of money, and instead of placing it, he's still got bills, money's still gone forever. We can't really defeat that. It is what it is. We all have gas, utility, power, cell phone. We have life expenses. We can't negate that. It's a real thing. But he got an IUL instead. So let's talk about an IUL real quickly. IULs, you hear us talk about be your own bank, plan for retirement, tax-free retirement. That is what we're getting at. So in an IUL, you have a 6 to 10% APY. And we're going to talk about internal rate of return, but 6 to 10% APY, right? Penalty-free access. You can touch the money in your IUL throughout your life. The 401k, your IRA, you can't touch it till 59 and a half without penalties, right? In your IUL, you get to touch it yourself. You get to become your own bank. You get uninterrupted growth. When you pull money out of the account, the money is still there against the market, still making a rate of return. There is no age restrictions. You could set this up when you're 1 year old. There's no age restrictions to withdraw. You could withdraw the money and take loans as soon as you have the cash value and the leverage in your account. You have leverage, right? You get to use the money, right? It's essentially a line of credit with an insurance company backed by your own contributions in the death benefit. You have guarantees. You're guaranteed a floor. That floor could range anywhere from 0 to 2% depending on the companies and stuff like that. You're guaranteed not to lose money, actual principal account dollars, right? And then it does not lose money, like we said. It's tax-free. Under certain internal revenue codes, 7702, 72E, and 101A, your money inside of a life insurance contract that is placed in there grows tax-free, can be accessed tax-free, and when you pass away, it blossoms and passes down tax-free. One of the only vehicle in the world that does that, right? It has living benefits. If you get critically, chronically, terminally ill, stroke, brain aneurysm, cancer, or something of that nature, while you're living, you could accelerate the death benefit that was granted to you upon the inception of the policy. It has immediate death benefit coverage, which also ties into the living benefits. But God forbid something happened to you tomorrow, your family has more money than you started with, right? It has principal protection. It is uninterrupted compounding account. When you take money out, the money is still there. Therefore, it can have a positive arbitrage on whatever you pull out in the interest charges. It can continue to make money, therefore outlasting and outliving a traditional account. It has no contribution limits. The contribution limit is designed when you set it up, and you can have multiple policies, right? So you're not stuck paying $6,500 a year like an IRA or $22,500 for a 401k. There's a lot of people who could afford more, right? So like $6,500 per year isn't that much when you're saving, say, even 10% of an income. When the average income is around $65,000, 10% would be $6,500. But as soon as you get past that, as soon as you're in $100,000, $200,000, $300,000 per year range, well, there's no contribution limits, right? Security is it's private and protected. Nobody can come for this money for the most part. It's private and protected from lawsuits, families, probate, anything of that nature. Your money is in insurance. An insurance contract is guaranteed to pay out upon your passing, okay? Flexibility, very flexible products. You don't usually want to be super flexible with your contributions because that could affect performance, obviously, right? And eventually, if you've done it long enough, your account's nurtured, and when you're putting money in, it's printing more out. But they're very flexible. If you started your contributions at hypothetically $1,000 per month, your minimums may only be $100 per month for the cost of insurance and the policy force. And then the remainder, $900, goes towards your accumulation account, right? So as long as you're in that window and you're above your minimums, well, your policy is going to stay open. But obviously, to keep it long-term growing and flourishing and blossoming, you're going to need to put more in. But it's super flexible, so you're not tied to it. There's times when you can pause payments if you need to. If you have enough money in the account, it pays for itself, right? It's self-sustainable. So essentially, you take all of that and you're putting your money. So money goes into your IUL. These are all the benefits of an IUL. And your IUL is essentially a vault. That is your vault. That's your baby. We are still going to calculate your IUL at $1,000 per month, right? Even though we totally alleviated the bank, but we all know most people don't put much money in the bank. So we're going to do your vault and your IUL at $12,000 per year, $1,000 per month. What happens immediately upon placing your money in this vault, into this IUL? Well, the first thing that you're given is a death benefit based off of your health and age. We get the minimum amount of death benefit in accordance to your contribution in the IRS codes to max overfund your policy so we could accrue as much cash as possible, okay? So let's say immediately, if you're about 30 years old and you're starting with $1,000 per month and you're healthy, you would have about a $300,000 immediate tax-free death benefit. God forbid something happened, it'll pay out to your family and they don't have to worry about the house or the cars or what are they gonna do without your income. Do we want to use that? No. Do we personally see that? No, unless it's paid out to us in living benefits. But it's going to be there for your family either now or later. It's permanent insurance, okay? And from there, so some of your funds go towards that. Then the rest of your money drops down into an account value. This account value is your accumulation account. This is the account that's linked to an external index, such as the S&P 500. Average APY in these accounts will be between 6 to 10%. Could it be more? Yes. Could it be less? Yes. Could it be negative? No. Floor would be about 0% to 2%, right? The IRR is 6.3% APY on average based off of a 7.23% in the S&P 500, right? So a 7.23% average would yield about a 6.3% APY. 6.3 is going to be our actual rate of return after all cost of insurance and fees. So after all said and done, after 30 years, you're going to have an average, like a 6.3, give or take, right? It can vary, depending on your cost of insurance, what age it was when you got this policy, how long you funded it. But for 30 years, we're going to see about a 6.3% internal rate of return, okay? This account is uninterrupted. This account value will never go down in value. Remember, it is linked to the index, and when you pull money out, you're pulling money from the next account, which is a cash value in the form of a loan. Okay, so that brings me down to the cash value. As your account value accrues growth and you're putting money in, you're putting money in, you're putting money in, your account value is going to spill over to your cash value, right? Typically around year 5, you're 100% cash on cash. You can see it a little bit sooner, you see it a little bit later. It's depending on rates of return and your cost of insurance for your age and health and how much you're putting in. But you're about 100% cash on cash around year 5, and which means if you put in 100 grand, you now have 100 grand, and now every year after that, you're cash flowing positive, and you've earned the death benefit, and you're gonna keep going. But from here, John's cash value opens up his own bank, right? So now, instead of him having to put his money in the bank, he now has his money in his bank. This is his personal bank, right? From here, there's a few things John could do. John could take a loan out, and he could buy an asset at 10.3% APY, right? So if John wanted, instead of pulling his money, like we were talking about, he wanted to go buy a car before and he didn't gain any interest. Well, John here, he could pull a loan against his account without interrupting the account value, so the account's still making money. He could go buy an asset like real estate. Real estate averages at 10.3% APY. That cash flows in that asset, pays the loan back, and when that loan's paid back, the money goes back into John's bank. It doesn't go to the bank, it goes to John's bank. So John's paying for it, and then he could do it again, and he could do it again, and he could do it again. This is the be your own bank concept in this policy. Once you have enough cash, you know how to leverage it, you just pull the money out, acquire other assets, allow those assets to pay the loan back, and put it back in the bank. And then, you don't have to do that. You could just strictly set these up for retirement. Hey, you want to put $500 a month away, $1,000 a month away, $2,000 a month away, strictly for retirement? Well, let's take a look at strictly what would happen for retirement. We throw $1,000 a month away, $12,000 a year away for 30 years, and we want to retire. John's excited. He's like, I'm ready to call it quits. I'm not going to work anymore. I want to see what's in my IUL. Account value, roughly $1.1 million, right? Give or take, depending on markets, but he has an account value of about 1.1. Well, you were like, hey man, well, we had more up here, right? Where are we at? Where are we at? So up here, we had about 1.2 million, right, in our 401k. So now you're thinking, well, it made more sense to be in the 401k. Well, really it wasn't, because the 401k was taxed, market risk, and once it's gone, it's gone. So 1.2 million was already 900,000. So we already defeated that, right? So here, he's gonna retire with $1.1 million. Guess what? Tax-free income from that, about $8,250 per month. One of the reasons why he's able to take so much more out of this, you're like, well, hey, that's not 4%. You did a 4% rule up there. The difference is a 4% rule in a 401k is because your money is no longer there compounding because you took it out. In an IUL, when he takes out his income of $8,250 per month, the money is still there, indexed, still making a positive rate of return as long as it offsets the interest charges. So he is still making money on his money. Therefore, he could take out more without depleting the principal as fast, okay? So that's what's going to happen. He's going to be super stoked. So instead of $3,000 per month after tax income, so $3,000, $8,000, tax-free, right? That's what's the benefit. He doesn't have to pay taxes on it. Doesn't have to take $8,250. He could take less, he could take more. He has a full account value of $1.1 million that's going to keep compounding for the rest of his life because the account value never goes down in value, okay? Let's take a look at what you would have to actually have in order to receive a 6.3% internal rate of return in a life insurance policy. So if you have a life insurance policy that has a 6.3% rate of return, what would you have to earn outside of an IUL just to get that same rate of return? Not including the fact a bunch of other things could happen, but 6.3%, you would have to add 30% for taxes because you're going to pay taxes. Tax rate would have to bring you up to 9%, okay? So your 6.3%, in order to earn 6.3% earn after taxes, you would have to get 9% actual rate of return. I just showed you the CAGR was 8% for the S&P 500, right? While Google's going to tell you average is 10, your actual is 8, but you're going to need 9 just to come close to a 6.3. you're gonna have to add 30% for taxes and 1% for fees. It's actually gonna bring you over 10%, but after your fees and everything, you're going to have to be over 10% actual rate of return just to even come close to that 6.3%, okay? So I'm not saying that an IUL, in fact, an IUL is not even an investment, right? It's an insurance policy. Investments have inherent risks. There's not risks with this, right? What was the risk, right? You're making money, you can't lose money, your family's always protected. It's a contract. The growth is tax-free. If you fund it properly, it'll take care of you and your family for the rest of your life. This is what the wealthy are doing. This is how you're able to put your money into an indexed universal life insurance policy, grow your money tax-free, be able to access your money throughout your life. You don't have penalties to access your money, right? You get to borrow from it, you can buy more assets, you can do whatever you want. You structure these policies based off of what you could comfortably save per month. If you could comfortably put it in and wait, just like you do with your 401k, you will be able to build a cash flowing machine, right? Because what's going to happen is 30 years from down the road, you don't have to keep putting money in. You stop putting it in. But guess what happens? Your money keeps compounding and compounding and compounding and compounding. You take money out, but your money still compounds because you never touch the actual principal dollars in the account. And then when you pass away, your family will receive not just the death benefit, but your full account value, whatever's left in your cash value account, which is the 100% equivalent to your account value once you've matured, usually around 10 or 15 years, unless you've touched some of it, they will get all of your cash value on top of the death benefit that you originally got. So your family will be, and they will also get it tax-free. Then there's plenty of ways to set them up for life as well, right? Rockefeller's generational wealth was created because when the family inherits tax-free life insurance, they must also purchase tax-free life insurance to continue the tax-free wealth through generations. So there's just so many different things you can do with this, but I just hope that was a clear picture on how you can put your money into an IUL. The money is going to be indexed. It's never going to lose money as far as market conditions and market losses go. You'll have to purchase insurance. There's an insurance associated with it, but it's permanent insurance. It's going to pay out when you pass away, right, or get sick. And then you could use your money while you're still alive. This isn't only for the wealthy. You get to design whatever your comfortable contribution is. And then say it's $1,000 per month right now. Well, say in 2 years, life changes and you can do 2,000. You can set up a second policy. You're not limited to one policy. You can have as many as you could get approved for. Again, you do have to get approved for them. They are life insurance contracts. Not everybody gets them, right? You have to be healthy within reason. You can have some prescriptions and stuff like that, but you can't have cancer, right? So you do have to sit down with an agent. So if you haven't spoken to an agent yet, go ahead and fill out the form below. One of our agents will reach out to you, schedule a call, a Zoom call. They'll design an illustration. They'll see what your goals are, what you're trying to do, see what makes sense for you, design a policy and see if it makes sense for you, right? It doesn't make sense for everybody because some people just don't have the financial means to save, or they're too old that they don't have enough time. It takes time, right? The number one thing that needs to happen in these accounts is they need to take time. 5 years is going to get you 100% cash on cash. Once you're past that, usually is when you're going to start cash flowing positive. That's when the real compounding effect happens. Then your money's doubling, 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 doubling. So again, if you haven't already talked to an advisor, fill out the form below. One of our advisors will be reaching out. Make sure your contact information is correct. They usually text you to schedule a Zoom call. So fill that out and we look forward to helping you.